Hi, and welcome back to our channel. Today, we shall discuss the psychology of investing. Investing can be an onerous task, particularly for those who are new to the game. However, it is not just about statistics and graphs. There is a great deal of psychology involved in investing. Let's delve into the intriguing world of investing psychology. First, let's discuss FOMO, or fear of missing out. Fear of missing out is a potent emotion that can lead to rash investment decisions. This can prompt investors to invest without conducting adequate research or analysis. It's important to remember that investing is a long-term game and that it's better to miss out on short-term gains than to lose money in the long run. Many investors made this mistake during initial public offering FOMO. Second, let us discuss the herd mentality. This occurs when investors invest in a particular stock or asset simply because everyone else is doing so. This can lead to investors neglecting their own analysis and investment objectives. It is essential to keep in mind that each investor's situation is unique, and that investment decisions must be based on individual circumstances and objectives. Finally, let's discuss overconfidence. Numerous investors mistakenly believe they are better investors than they actually are. This can lead to excessive trading, excessive risk-taking, and rash decisions made without adequate research. Remembering that investing is a learning process that requires continuous education, and self-reflection is essential for maintaining humility. Fourthly, we will discuss loss aversion. This occurs when investors dread losing money more than they anticipate gaining money. This can lead to investors holding on to losing investments for too long, in the expectation of breaking even, rather than recognizing their losses and moving on. Losses are an inevitable part of investing, and it is preferable to accept a minor loss than to hold on to a losing investment and risk losing even more money. One way to avoid this situation is to be disciplined and practice strict stop losses, especially in day trading or short-term trading. Let's conclude by discussing confirmation bias. This occurs when investors only search out information that confirms their preconceived notions about a particular investment. This can lead to investors overlooking crucial information that could challenge their assumptions and subsequently making poor investment decisions. When making investment decisions, it is crucial to maintain an open mind and seek out a variety of perspectives and information sources. Before we move on, please help our channel by hitting the like and subscribe buttons. This will be a morale booster to our crew and help them to create more interesting videos. Next, there are also two emotions that are crucial to understand in investing and trading. Fear and greed are two potent emotions that can significantly influence the decision-making process of an investor. Fear can cause investors to panic and liquidate their holdings during market downturns, while greed can lead them to take on excessive risk in pursuit of profits. A well-defined investment strategy that takes various market conditions into account is one method to combat these emotions. By having a clear strategy, investors can stay focused on their long-term objectives and avoid making decisions based on fear or greed. In addition, investors should endeavor to maintain a portfolio that consists of a variety of asset classes. This can aid in risk mitigation and provide a buffer against market volatility. The VIX index, also known as the Fear Index, is a measure of expected volatility in the stock market over the next 30 days. It is calculated based on the prices of options on the S&P 500 index and is frequently used to gauge investor sentiment. When the VIX is low, investors are likely feeling confident and the market is relatively stable. In contrast, when the VIX is high, it indicates that investors are anxious and that the market is likely to experience substantial volatility. While the VIX can be a useful instrument for investors, it is essential to keep in mind that it is merely one data point, and should not be relied on exclusively when making investment decisions. When making investment decisions, investors should also consider market trends, economic indicators, and company-specific information. In conclusion, there is more to investing than numbers and diagrams. The psychology of investing is crucial to making profitable investment decisions. It is essential to recognize these psychological biases and adopt measures to overcome them. By doing so, investors are able to make informed and rational investment decisions that are consistent with their individual circumstances and objectives. Fear and greed are potent emotions that can also influence the decisions of investors. By sustaining a diversified portfolio and adhering to a well-defined investment strategy, investors can mitigate the impact of these emotions. When making investment decisions, the VIX index can be used to gauge investor sentiment, but it should be considered alongside other data points. We'll see you in the next video, and thank you for viewing.